Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is August 20th, 2026. My name is Jonathan Liang, and I want to talk about the announcement from the US Treasury last night. The US Treasury announced last night an increase of its Treasury buyback program, doubling it to $4 billion from $2 billion to curb the recent surge in long-term bond yields. It is important to note that this came from the US Treasury and not the Fed, who theoretically can buy unlimited amounts of treasuries with their balance sheet, whereas the US Treasury is only talking about a $4 billion program. As a result, overnight market moves were relatively muted. 30-year yields dropped 9 basis points, closing at 5.19%. 10-year fell 6 basis points to 4.65, and 2-year was largely unmoved. Meanwhile, the US dollar fell 0.8%, helping gold bounce to around $4,517 per troy ounce. While the announcement may sound dramatic, it essentially is an expansion of the US Treasury's existing liquidity management tool. The Treasury has long used buybacks to support secondary market liquidity in off-the-run treasuries by issuing lower-yielding short-term debt and buying back higher-yielding, longer-dated, not-yet-matured securities where trading is thin. Doubling the program from $2 billion to $4 billion is small relative to the overall $30 trillion Treasury market and is unlikely to be a major market driver. Crucially, this is a Treasury recycling exercise, not the Fed using QE. Although the initial market reaction was lower long-end yields, a weaker dollar, and higher gold, markets already appear to be settling down as investors recognize that the announcement is not by itself a game changer. There is a risk that the Treasury buyback announcement might actually make the US Treasury look desperate and might trigger an even worse sell-off in treasuries, which might actually start to affect broader financial market conditions, which might actually require the Fed to step in to stabilize things with some kind of real QE or yield curve management, even though Walsh has said he wants to shrink the Fed's balance sheet. If the markets start to anticipate this could be dollar bearish, gold bullish, and bond bullish, but market volatility will need to be high enough before the Fed can justify restarting QE. We continue to expect range-bound yields as concerns around loose fiscal and uncertain monetary policy, coupled with the recent surge of bond supply from hyperscalers, has raised the term premium. These concerns are likely to keep long bond yields elevated but range-bound in the near term. However, bond markets are ultimately going to be driven by macro fundamentals. Recent run of U.S. macro data, softer payrolls, cooling inflation, and drop in retail sales has been supportive of our long-held view that the U.S. inflation peaked in the second quarter. Long-term inflation expectations have remained subdued all along. Last night, the minutes released from the FOMC showed a split committee with 3 governors wanting to raise rates, while the majority wanted to see more incoming data. Recent data should give this group comfort to remain on hold for now. Thank you for listening, and we'll speak again in future episodes.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.